from Antique Stock Broking. Please go ahead.
Yeah, hello, am I audible?
Yeah, you are audible.
Yeah, thank you for the opportunity. So my question is again on the depreciation part. So on a sequential basis also, like the earlier participant mentioned, there is a very sharp jump in depreciation, and also on the annual basis, the average rate of depreciation turns out to be around 7.5 to 8% of the gross block, compared to around 6.5% in the last year. So what should be the annual depreciation rate we should be seeing going forward, and is there any change in depreciation policy that we have taken?
Yeah, slightly. There was higher depreciation because of, as we discussed, that the new facility, especially in Africa, the depreciation rates are slightly higher. So we started 2 new facilities in Africa, Senegal, and Togo. So, but going forward, the depreciation rate, as we do more capex in India, so that the depreciation rate will come down to same levels as we were earlier.
Okay, that's helpful. Secondly is on the EBITDA per ton for the aluminium segment. So currently we are doing approximately 14 to 15 rupees per kg, 12 to 13 rupees per kg of EBITDA for aluminium segment. Going forward, once the MCX hedging is in place, what do we see the stabilized EBITDA for aluminium segment?
So in this quarter, the annual number for aluminium per ton is around 12,000 rupees. But for this quarter 4, we realized around 15 rupees per kg. So that 15 to 16 rupees per kg is a fair estimate of going forward EBITDA per ton for aluminium.
Okay, and this is at the current utilization levels, 15, 16. So as the utilization levels improve, is there a possibility of per kg EBITDA improving, or 15, 16 will remain constant?
So 15 to 16 is a range. So we can reach to slightly towards 16 if this capacity utilization goes improved in this year.
Okay. So next is, if you can just help us with the domestic scrap collection for India plants for the 4th quarter.
So domestic scrap collection for India is in this year, 4th quarter is approximately 40% for the Indian scrap requirement.
Okay, that's helpful. I'll come back in the queue for a few more questions. Thank you.
Sure.
Thank you. The next question is from the line of Praful Siddharth from Shravas Capital. Please go ahead.
Hi, sir. So could you please throw more light on your interpretation of Ind AS 19 with regard to auditor's qualification? Because based on our understanding of Ind AS 19, this expense is something which needs to be taken to the P&L and not other equity.
Okay, so basically first we need to understand the transaction which we did and then in light of the years. So one, I think we mentioned that there were some equity shares which were held by the trust and the scheme was that the appreciation will be distributed or utilized for the benefit of the employees of the Gravita Group. So this was the scheme. So when we sold those shares, there was some gain, and so we because it is a treasury share, so we were not supposed to book the gains in the P&L. It was supposed to go to the equity part directly to the reserve. And when it came to the distribution or utilization of that amount for the employee benefit, so it was suggested to auditor have suggested it to be provision for in the employee benefit expenses. But our contention was that since it is a distribution of the income which is not, which is gained from the shares held, so it was not a share-based payment according to our estimate and the legal opinion we have taken from various law firms. So it was supposed to go to the only the distribution was supposed to go to the reserve only as it was the treatment for the income also. So income, and so what we did is we have considered the income also in the other equity and the provision also in the other equity. So there is a liability standing on the balance sheet, and there is a investment which is lying on. So in future, there will be distribution of this amount gain to the employees, and then both of the legs will be squared off. So, but auditors was having a different opinion or interpretation of the accounting standard, and we took our own opinion, including some opinion from EY also. Based on that, we concluded this.
Right. So we took the opinion from EY, sir?
Yes.
Got it. So just one more accounting question. So in FY23, we recognized the forward contracts gain in other income. And in FY22, we recognized the forward contract loss in other expenses. So considering the accounting policy in FY22, don't you think we should have directed the gains from other expenses in FY23 instead of taking it to other income? So why has there been a change in accounting policy here?
So it is like, so what we do is whenever there is a loss on the hedging, it goes to the other expense. Whenever there is a gain on the commodity hedging, it goes to the other income. So, as per this is as per the accounting standard, but because the hedging is part of the operational transactions, or it's in back-to-back against the physical transaction, so we consider this other income. Other expense is always part of EBITDA, but other income normally it is to be excluded from the EBITDA part. But since it is part of our operational income, we consider adjusted EBITDA and we report it in that way, so that we consider this as the operational income.
Got it, sir. Thank you. Thank you so much.
Thank you. The next question is from the line of Parikshit Kabra from PKD Advisors. Please go ahead.
Hi. Thank you for the opportunity. I first wanted to understand that last quarter our EBITDA margins rose up to 11% because, we were diverting to new customers and using the cheaper raw material. This time it's come down to 8%. Can you explain that, how that has happened, and what should we expect in the next couple of quarters from an EBITDA margin perspective?
So basically last year we had mentioned that there were some arbitrage opportunities present in India, because of which the EBITDA margins were higher. But this quarter it's not 8%, it's 10.76%. So there was some increase in EBITDA percentage in Q4 in last quarter. The EBITDA margins were 11.83%, which was abnormally high because there were some arbitrage opportunities in India and we had diverted that material into India. But you can expect a 9 to 10% EBITDA margins on a sustainable basis going forward.
So maybe in your calculation, as we mentioned, that we are considering this hedging income also as a operational income, which is part of the EBITDA. So if you include that, so this which is for this quarter 4, it is approximately 21 crore, and for the entire full year, it is 47 crore.
Fair enough. Understood.
If you include that, this EBITDA number will be approximate. EBITDA percentage is approximately 10.76% for quarter 4 and 10.47% for the full year.
Got it. Understood. So the second question that I've had was that, I understand the Red Sea issue has created some level of issues for us, and we have missed our guidance, a long-term guidance, but divided into shorter term, and we have missed it this year. And next year you have given a guidance on a top line of 25%. But can you break this down, in the sense, what are we expecting next quarter? Or is this also going to, this 25% growth is also going to be backloaded towards this third and fourth quarter, or can we start expecting that from the first quarter itself?
So part of this growth you can start expecting from first quarter itself. So it will not be too much towards the last quarter. So quarter on quarter basis, generally it's very difficult to give you any guidance. But definitely it's between 20 to 30% throughout the year, unless something strange happens again. If everything remains normal, you can expect a 20 to 30% growth rate on a quarter to quarter basis.
But even for quarter one, it is too difficult to give guidance because we're sitting in quarter one, right?
Yeah. So you can expect, as I mentioned, you can expect 20 to 30% growth rate in the first quarter also.
Got it. And aluminum business, now that from what I understand, that we were holding back only because of inability to hedge. Now that the hedging is going to be possible in Q1, what kind of volume growth or top line growth are you expecting for the aluminum business in this quarter or the next quarter?
So the benefit should arrive somewhere around next quarter because it has been notified in the month of March, but the effective contract should start somewhere in next quarter. And the physical delivery things should happen in further Q3. So we should expect this advantage of hedging somewhere around Q3 onwards. So as we mentioned, that Indian utilization was lower, that was only 11%. That should go to 60% after Q3 and Q4. So that number will come. Certainly, whatever we did last year in aluminum business, that will grow at least by 60 to 70% in terms of volumes, because we are also adding capacity at certain locations at Ghana that should operational in beginning of the Q2.
Got it. So just to repeat and make sure I understood correctly, from last year to this year in volume terms, aluminum business should see a 60 to 70% growth.
Yes.
All right. Perfect. Thank you. Thanks a lot.
Thank you. The next question is from line of Ankit from Market Cord Research Private Limited. Please go ahead.
Yeah, my question is in terms of external producer responsibility certificate, right? What percentage of volume in India are we generating?
Sorry to interrupt, sir. May I request you to please use your handset?
Okay, so my question is, what is the EPC certificate which we have generated in India already, which is eligible for sale?
Yes, we have generated EPR certificate for lead-acid batteries, for plastics. So these data are already available on the portal. So you want the number, the quantities?
Yes, I want the number and quantity, and what is the sales we realize of that?
See, the realization will take place later once we start trading them. So we have generated, and wherever we took material from the producer, in that case, those will be given in turn because the material is being given by that particular battery manufacturer to us. So that will be traded in lieu of the material given. For the rest of the producers, whenever they will come to fulfill their liability of EPR, then this will be traded. So the fair price will come out whenever there is a penalty is finalized. So that we foresee in next quarter. So as of now, the financial numbers cannot be, it's not available because let us see what number it comes.
So what is the volume against which we have EPR generated, right? Because that is
around 24,000 last. 24,000
for 24.
For 22, 23. 23 is around 25,000 tons.
And what percentage of it this is for lead?
This is for lead only. This is for lead. And plastics numbers are different. As of it's not readily available, but we can certainly share.
Thank you.
Yeah.
Thank you. The next question is from the line of Vikas Mistry from Moonshot Venture. Please go ahead.
Yeah, thanks for the opportunity. Yogesh, I have a couple of questions. Last quarter, we are losing some of the tolling business. So can you quantify in this quarter how much we are losing on tolling business and how we can be so sure that there will be strong rebound in the next quarter?
So, I would like to just correct you a little bit that we are not losing the tolling business, but we have decided to rely more on international battery because there was some arbitrage opportunity in last quarter where Indian prices were higher. So it was more beneficial for the company to import batteries instead of using the domestic batteries. But in this quarter, we have increased the total quantity that has come up. So overall, if you talk about in the Indian import and domestic procurement, we have increased the procurement by 22% last year. But we have imported more than we have used the domestic batteries. But in the last quarter, if you look at it, we have, again started using domestic batteries. And it's around 11,000 tons of 12,000 tons of domestic battery that we have bought this year. So if you compare it with the Q3, which was around 10,000 tons, so it's around 20% growth over Q3 in the last quarter for domestic batteries.
Okay. You want to say that whatever the Red Sea is there, you are not materially impacted from here on. That's what you want to say?
No. Red Sea is basically an impact on the sales of our products from India to and East Africa to Europe. It has not impacted the import of battery scrap into India because we are importing from Americas and from Africa. There is no impact of Red Sea on import of battery scrap into India, or very little impact of battery scrap into India.
Okay, so you are fairly confident that the volume growth will come back in Q1.
Yes. So as I mentioned that we have grown, the total procurement growth in India is 22% last year.
Mm-hmm.
So whether it comes from domestic or it comes from international, the overall growth in battery scrap is 22%.
Mm-hmm.
So we always look at the best option to buy. So if the import prices are lower, then we buy international battery, and if the domestic prices are more viable, then we increase the battery procurement locally.
Okay. My last question is that we have said that we are going to through MCX with this aluminum alloy. So how much of our portfolio is still after doing this? How much of our portfolio is still unhedged?
So if we start doing hedging on aluminum, only plastic remains unhedged, but otherwise lead and aluminum would be 100% hedged.
Okay, aluminum, all other alloys will be hedged. Only to ADC 12 will be hedged.
ADC 12 is around 90% of the total aluminum alloy that we make.
Okay, that's all from me.
And the prices of other alloy also move in tandem with the ADC 12 prices. So you can hedge ADC 12 and then still have some amount of hedging for other alloys as well.
So just to clarify, lead is fully hedged at this moment, but aluminum is partly hedged just because at this moment we don't have the hedging mechanism in place. But as mentioned that whenever we have that platform of MCX, we will be doing 100% hedging for aluminum also.
Currently, we do some hedging of aluminum, which are on LME, but that's a non-ADC product.
Okay. Thanks. That's all from my side.
Thank you. The next question is from the line of Tia Brijwani from White Whale Partners. Please go ahead.
Am I audible?
Yes.
Yeah. So my question was on the regulation bit. If I compare the 2001 regulation versus the 2022, 2001 also had some guidelines around, let's say for the producer, they had the responsibility to collect that, let's say 50% of the new batteries sold. So and things didn't change materially after that in terms of like informal shares still remained high. So my question is, what is fundamentally different in the 2022 regulations, which would basically divert the ULAPs from the retailers versus what was there in 2001? So am I reading this correct? And what's your view on that?
Yeah. So you clearly told correctly, when it came in 2001, the percentage they were to collect was 70, 80, 90 and 100 by next 4 years. But the regulation which was applicable on everyone. All 100,000 of retailers were also part of that regulations. They were to file return, but effectiveness was not there, because if you apply the regulation on thousands of people or lakhs of people, it will not be effective. So there was one more change was brought in 2010 where bulk customers were added. So slightly from bulk customer side, the battery or scrap was generated and it was coming in the system. But in this regulation of 2022, two things were the major. Here the regulation has been it will be on producers only. So here you have to regulate few people. In case of lead acid battery, there are 10 or 15 major producer of batteries. So it is easy to implement the regulation. Second part, EPR. In old regulation, there was no responsibility. So there was no EPR. There is no EPR penalty. So these two things will change the landscape of regulation.
Got it. So just to follow up on that, let's say I, as a retailer, I'm getting a higher price from the informal guys just because they don't follow the compliance norms, or let's say there's GST evasion and stuff. But you're saying that this 2022 regulation, will it enable us to come at par with those prices? Because retailers were the main point of leakage of these used labs. So are you alluding to that?
Yeah. So one of the premise of putting the onus on the brand owners is that they can control the supply chain. So most of the batteries, new batteries, wherever the new batteries are sold, they are sold, and replacement of the old batteries are done at the same place. So the premise is that whenever you need a new battery, you will get an old battery in lieu of that new battery. So if the brand owners, battery manufacturers like Amara Raja and Exide, they can, because they control the supply chain, they can put pressure on these retailers to give back the old battery. Only then they will give the new battery to them. Then they can, to some extent, control and reduce the number of batteries going to the unorganized channel. That is first part. And once they start doing it, probably the channel will follow. So hopefully it will start having impact in the future. And of course there are other things also that is happening, because GST is being implemented in a proper manner. The government is getting stricter in terms of GST evasion and all those things. So these are also some of the policies that are helping this shift from unorganized to organized.
Okay, cool. That's it from my side. Thank you.
Thank you. The next question is from the line of Kush Nahar from Electrum PMS. Please go ahead.
Yeah. Hi. Thank you for the opportunity. So my first question was, what was our domestic scrap collection for Indian operations as a percentage?
So for Q4, it was 40%.
40%. Okay. And so in the presentation, I see that there is this Australia which has been added in terms of a procurement network. So what's the strategy there? Are we looking at new products over there, or is it the existing verticals only that we're expanding the network for?
Yeah. So we have started developing some vendor network in Australia also, and we have started sourcing some battery scrap from Australia. And in future, we are thinking of putting up some our own yards also in Australia.
Okay, sir. And so just one last question on the EBITDA margins after the aluminum hedging. What would be the sustainable EBITDA per kg we can guide across all three segments?
For aluminum, you're talking about 15 to 16 rupees.
Yeah, and the other two, lead and plastic also.
So lead, we expect to 18 to 19 rupees per kg, and for plastic 10 to 11 rupees per kg.
Okay, sir. Thank you.
Thank you. The next question is in the line of Basant Patel from TCGM AMC. Please go ahead.
Hello. Yes, sir. Thank you for the opportunity. Sir, just one question on the domestic front industry scenario. Even Amara Raja is also getting into 1 lakh tons of the lead recycling capacity. So even if excites this segment recycling lead capacity, so don't you feel the domestic would be more pressure to procure the raw materials, battery components and all? So how do you feel this?
No, so the opportunity itself is huge. Currently, if you look at the total capacities in the organized sector, they are not capable to fulfill the entire requirement. So every battery manufacturer, just because he has to comply with the new regulations, would have to find solutions. So part of it is going to come from contract manufacturing with companies like us, organized recyclers, and part of it is going to come by their own internal capacities. So I think it's going to because the opportunity itself is so huge that even if their capacities come, it will not overall impact growth that we have envisaged for the next 4-5 years.
Yeah. Okay. So whatever you procure from Amara Raja, that is going to be lost going ahead. Is that we can?
So basically, what is going to happen is that Amara Raja is only putting up a plant in south, but they sell this battery everywhere in India. So we have plants in north, we have plants in central India, we have plants in west India. So wherever the battery is getting sold in these regions, they would come to either us or companies like us. The specific benefit that we have is that we can process it in the northern plants, and then we can give the finished products to Amara Raja from the south plant itself. So that gives us an advantage over the competition. So and similarly, there are other battery manufacturers also. If this gets implemented, only two of the big players like Exide or Amara Raja are the players who can put up their own plant or who can buy these batteries. The smaller players would also need partners like us. So there is a huge opportunity there also. When these small players who do not have that much clout on the supply chain, they would need a partner like us to collect that battery from the retailers and then process it and then give it back to them. So that would be other requirement that will come up. So overall, if you look at the total capacity, the plant that they are putting is not even 20% of the total capacity in India, Exide and Amara Raja currently.
Yes, sir, that is correct. So industry opportunity is huge largely, so that will not be a threat for us actually. So that's, yeah. Sir, and one more thing actually, I missed the one part that you were commenting on the lead procurement from India would be more expensive than lead what you are going to procure from outside for the recycling material outside India. What is that statement, sir? Can you please...
It's basically India market moves independent to the international markets. So sometimes there is a scenario where Indian markets are much higher. During those times, it makes more sense for us to bring international material into India, process it in India, and then supply to the Indian market, rather than procuring it in India. So there is an arbitrage opportunity during those times, which was in the Q3 and part of Q4. So we take benefit of whenever those arbitrage opportunities arise. So that is why you will see that the overall EBITDA margins was also higher in Q3 because imported batteries were cheaper. But these opportunities are not continuous. So there would be certain times in the year when you will have these opportunities. Otherwise, the best way to deal is whenever you have Indian requirement, you buy Indian material and give it to Indian buyers, and the international market, you buy international material and supply to the international markets. Am I clear in this?
I'm clear, yeah. So in Q4, actually, if you look at the...
Sorry to interrupt. Due to time constraint, we would like to move on to the next question. I would request Mr. Basant to follow up in the queue. The next question is from the line of Siddharth Mehrotra from Kotak Institutional Equities. Please go ahead.
Hi, sir. Am I audible?
Yes, you are, sir.
So just a quick question on your capex numbers. So I was just looking at the capex you had guided for in your previous presentation versus the new presentation, and I see that the FY24 capex is actually much smaller than we had guided in the past. So can you just explain what sort of projections we are altering, what is the progress on our new verticals and so on, and how should we look at this capex? Will it be majorly back-ended towards FY26-27? What are your views on that, sir?
Yeah. So, yes, you're right. Some of the capex that we had planned for the new verticals, especially lithium-ion battery recycling, we were not able to do that in last year, and it spilled over to this year. And you will see that coming up in this year, the lithium-ion facility in Mundra. And part of that, from the existing vertical, part of it was to put up a new facility for aluminium recycling in Mundra, which was also delayed because we were not having any hedging mechanism, so we did not want to put a new capacity because until the hedging mechanism is there, we did not want to go into putting up a capex that, so we realized that later. So we changed our strategy a little bit and we started putting up capacities of aluminium recycling overseas. But now, once this hedging mechanism is live, then we may start thinking about putting up this capacity again. So these are two major factors that affected the CapEx plans.
Understood, sir. And what about the progress on the new divisions which we were sort of overseeing, the paper and the steel part?